Tesla's stock price has been plunging, and at a very fast rate. While the stock market remains extremely volatile and there seems to be no actual cause for this drop, some analysts have suggested that a share buyback could be an effective way to drive Tesla's stock price up, amidst the significant dips that it's been experiencing in the last few weeks. Hey everyone, welcome back to Everything Tesla Stock. Tesla stock recently dropped another 2.9%, closing at $216.50, while the S&P 500 and Nasdaq were down 0.7% and 1.1% respectively. At the time, shares of the automaker were down about 25% since September 28th, just before Tesla released its third quarter delivery numbers. With the company's stock constantly dropping at a significant rate, many fear that if the stock value remains down, it's more likely to continue to plunge. To prevent this, analysis suggests that Tesla buys back its shares in order to boost the price of its stock. When a company buys back its shares, it typically uses cash to buy shares of its own stock on the open market. One of the goals of a profitable public company like Tesla is to maximize shareholder value, meaning that it is able to generate the highest return possible for its investors and increase the value of its stock. One way to do this is by buying back its shares, thereby raising demand of the company's shares and boosting the stock price. What will a share buyback mean for Tesla, and will it be a lasting solution for the plummeting stock price? Keep watching to find out, but before we get into it, if you like this type of content, don't forget to like and subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Tesla stock has not been performing so well in the last few weeks, and several investors fear that it might continue in the coming weeks too. There have been recent concerns about the demand for Tesla's EVs, with inflation driving up production costs and the rising threat of a possible global recession. In addition to this, the combined results of Tesla's AI Day and its delivery reports have also contributed to the tensions among Tesla investors. Although it is difficult to fully determine which factor played a greater role in the stock dropping over the last few days, these events ushered in the worst week for the company's stock in a long while. And to top it all off, Tesla's CEO Elon Musk announced that he is also continuing with plans to buy Twitter. In response to the plunging stock price, Morgan Stanley analyst Adam Jonas recently cut his base case price target for Tesla from $383 to $350. According to him, Tesla is likely seeing demand destruction, which will be reflected in shorter lead times and price declines in the coming months. Could a share buyback be a good option for Tesla to increase its stock price? Keep watching to find out. Since stock buybacks remove cash from a company's balance sheet and potentially reduce the number of shares outstanding, they can also have a wide impact on the key metrics investors use to value a public company. And some analysts believe that this could be a good way to boost Tesla's stock price in times like this. Stock investors like founder and chairman of Xi International, Leo Kogoan, have at some point supported the idea of Tesla buying back its shares in times of significant drops in its stock price. Earlier in May, Kogoan called on Tesla to announce a $15 billion buyback with its stocks, when the company's share price continued to fall at the time. He said this via a tweet to Martin Viecha, Tesla's senior director of investor relations, stating that Tesla should immediately announce its plans to buy back $5 billion of its shares this year and $10 billion next year. He added that Tesla could use its free cash flow to fund the buyback, stating that the move shouldn't affect its existing $18 billion cash reserves. However, while some investors may also believe this, others like famous YouTuber Dave Lee have a different opinion. According to Lee, although he believes that Tesla's share buyback will be a good way to return cash or value to shareholders, he does not see it as the right option to boost Tesla's stock value at the moment. The popular YouTuber cited that Tesla is a capital-intensive business and should not use its capital reserves or issue debt in order to finance a share buyback. Lee added that in a situation where the company needs to fund the finance of its projects or cushion the effects of an economic downturn on its business, then it will have to incur more debts, putting it in a more vulnerable condition and weakening its financial position. He also further stated that rather than the company's long-term or short-term stock price, what really matters is Tesla's execution towards making products that people want, and investing in new products and markets that will boost the company's growth in the future. During share buybacks, a company returns money to shareholders that it doesn't need to fund operations on other investments. While this may seem like a good idea, it's actually a rather risky one for companies like Tesla that are vulnerable to changing market conditions, such as supply, production, and delivery issues. Lee believes that Tesla does not have enough cash reserve to fund a buyback at the moment. No doubt Tesla's stock price is plunging deeply, and investors may attribute this to the recent events with the car company. However, Tesla investors may be focused on the wrong thing. Although Tesla's third quarter earnings didn't meet expectations, the automaker had an explanation as to why this is. Unlike some other automakers which have had to reduce delivery of vehicles because they haven't been able to get the necessary parts and components to complete production, Tesla didn't have any such issues. Even better, its production figures have grown, making it difficult for the company to line up the necessary resources to get its vehicles to buyers. These strains on the transportation system have caused shipping costs to rise, particularly during the end of quarter periods, during which Tesla has strengthened its efforts towards vehicle movement. Likewise, the car company has taken greater advantage of its growing network to optimize its vehicle building efforts. However, while this has improved Tesla's efficiency, it requires even better logistics to facilitate the delivery of these cars. Also, Tesla has done well in terms of car production. Its production figures soared to nearly 366,000, which is significantly higher than values recorded in some previous quarters. The 22,000 vehicles, which are a difference in Tesla's car production and delivery, is majorly an issue of timing, which is a lot easier to resolve than production issues that the majority of Tesla's rivals are facing. Although logistical problems aren't minor, they're not permanent, and while they do subside, Tesla could deliver the 500,000 vehicles it hopes to when things get back to normal between now and the end of the year. In an exclusive report in September, Reuters cited internal Tesla documents that showed that the company aims to produce more than 500,000 electric vehicles in the fourth quarter of this year, and then maintain that production pace throughout next year, or even increase it. Tesla's Q4 predictions have been very positive, and if the car company can ramp up its production to 500,000 or more vehicles in the fourth quarter, then this would represent at least a 35% sequential growth rate for Tesla. The automaker is still aiming to produce 1.6 million vehicles in the first 3 quarters of 2023, putting it on track to sell more than 2.1 million EVs over the course of next year. According to Reuters, a 2.1 million vehicle annual production rate would make Tesla a bigger automaker than Audi, and close to BMW, which produced 2.5 million last year. Likewise, the car company recently set a monthly record for China-made EVs back in September. The company delivered 83,135 China-made electric cars, according to data from the CPCA. This is an increase of 7% and a record for the factory in Shanghai. Tesla plans to keep production at the Shanghai Gigafactory at about 93% by the end of this year. Musk has also previously told investors that he's aiming to get Tesla up to 40,000 vehicles per week by the end of this year. There is no doubt that a buyback for shares will be beneficial to Tesla in some way, but it is important to understand that once a company is bought back its shares, it reduces the amount of outstanding because the purchased shares are either cancelled or held by the company as treasury shares. And reduction in a company's outstanding shares has implications for many important measures of a company's financials. According to Dave Lee, Tesla could be in a better position to buy back its shares once it's had its cash power of about $30 billion. And he believes that this could happen in the middle of next year. Do you think it's a good time for Tesla to buy back its shares? Let us know down below, and don't forget to tell us what your valuation on Tesla is. If you want to know more about Tesla and what it's been up to in the last few days, go ahead and click on this video on your screen. See you there.